Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is October 29th edition of Market Outlook. And for this week and this week only, I'm going to include not only the free version, but a premium version in one single video. This will be changing over the next couple of weeks. So let's get into what the details are and see how the markets are setting up and take a look at some new opportunities as well. So first thing to note here is, as you can see, our risk gauges are just showing a very, very positive trend net. We have a little bit of deterioration because utilities have actually started kicking in a little bit relative to stocks, but net overall risk on is still in gear. So let's take a look at some of the individual indices and exactly how they're setting up and where the opportunities lie. So the first thing I want to point out is that we did make new closing highs in the S&P, explosive move in the NASDAQ 100. IWM basically has still been within the trading range, and even though we closed up nicely for the day on Friday, we haven't really been able to take out the trend line, which is now we're just sitting underneath the trend line and sort of in this compression zone as well. So IWM not able to get some really great traction. The leadership here now has moved back to that NASDAQ 100. Now, the thing that's most interesting in terms of the setup is this little bit of a compression range here in the Dow. So looking forward here to next week, we definitely on our real motion indicators are set up the strongest still in the Dow, right? We're trading well above the 200-day of real motion, and that is the strongest relative to all the other indices. IWM sort of basing out along with this sideways sort of channel, or you can say a very, very extended flag type formation here. So the two things that I really want to watch, again, is the breakout potentially to new highs on the Dow, and a breakout above that upper trend line, and we'll take a look at that on the intraday charts in a moment. But let's go through some of the other key components here of our big view charts. So the next thing, just looking at SPY versus utilities, as you can see here that our indicator is showing a little bit of weakness here. We're still above our 6-month indicator in terms of the strength of the S&P versus utilities. However, over the last couple days, you can see as we're trading, the red here is the actual ratio. The black line is the monthly moving average, and basically we've been trading under it on the in the SPYs. So a little bit of weakness there, but if you take a look at all of our other key ratios in big view here, SPY versus bonds working just fine. High yield debt versus the safety of U.S. bonds. Again, high yield debt still acting strong. That's a real positive. The safety play of gold versus the S&P. You can see here the S&P also just pulling ahead and acting very strong. And the same thing looking at really lumber, which is a good indication of housing and overall economic activity, and that is outperforming gold as well. So net, all of our key intermarket relationships in gear. If we take a look at the sectors, we're getting a overall positive story, but considering just how strong the week was, in terms of the NASDAQ. What's interesting is you can see that the spiders over the last 5 days barely up. However, what has led the charge is semiconductors, technology, and financial. So overall, this is a pretty good sign. The flip side of this is what's strange is that look at the number of the sectors that are actually negative on the week. So, that gives me a little bit of pause. I'm going to keep that in the back of my mind here. You've got healthcare, the industrials, transportation, real estate, energy, consumer staples down. That's not such a bad sign. That's pretty good, right? Speculative money definitely running into semiconductors and tech. And of course, retail is still in trouble. So when you get 7 out of the 14 critical sectors here negative in a positive week, that is definitely a bit of a caution and something to keep track of here, because if things start deteriorating in our leading sectors here, that's going to spell some potential trouble. If we take a look at volume analysis, again, overall, look at the number of accumulation days versus distribution over the last couple of weeks. That's been overall very, very strong, especially in the diamonds and the S&P. Now, the NASDAQ had been sort of lagging, and it's still sort of iffy, even with that blowout to new highs. So again, I always say price action is most critical, and everything else is sort of secondary. Can't really argue with the trend in the NASDAQ 100. It's up very, very strong, stacked and sloped across the board of all the different moving averages, closing on new highs, and of course, year-to-date change. The NASDAQ is up 27.65%. You cannot argue about that type of performance. So all that is looking pretty good. Now, taking a look at a couple of other different hotspots here, what is interesting is you can see, despite the talk on Capitol Hill about trying to restore coal and sort of dirty energy, what is interesting is the strength in solar, right? So I'm pointing that out. It was up 6.4% for the week. First Solar, one of the leading stocks, up over 20% on earnings. So what's interesting, solar definitely in the leadership. Several of our models are in solar. In fact, 2 out of our 3 components of our ETF complete model hold TAN, the solar play. So that's pretty good. Now, the other thing to note is that sugar, which had been pretty beat up, moved into a recovery phase, up almost 5% for the week. So that's interesting for commodities as well. So the other thing to note, besides the sugar, solar, the other thing I want to focus on is U.S. oil, USO. So this is our West Texas Intermediate Oil Fund, and you can see up very, very, very strong for the week, up almost 4%. So with the improved economy growing at about 3%, which is pretty strong on a relative basis, some of the strongest we've seen in over 10 years and even longer, or consistent with the strongest results of our economy over the past decade for sure. This is an interesting sign. Higher demand for oil, not surprising. So we're going to keep an eye on that. Obviously, we like this play, and have been in on that on a discretionary basis. So those are your key things that are occurring. And let's go take a look at a couple of other charts here as well in greater detail. So um, let's see. In the premium section, I'm going to move into it here and let's see what's happening. Looking at market internals, the thing I want to note is with NASDAQ 100 blowing out to new highs, let's just take a look at the new high, new low ratio. And what I had mentioned in our text was that there's definitely some issues there, and the breadth is getting narrower even as we're moving up to new highs. And you can see that on our chart here of the new high, new low ratio. So the 10-day and the 21-day moving average of the new high, new low ratio on the Qs trailing off, which means that the rally is definitely getting narrower. Now, that often occurs. The market still continues on to new highs without a major sell-off. It does occur. Even you can see as recently as just several months ago, you can see there was some deterioration here. And all we really managed to do was go sideways before it sort of exploded to the upside. Now, these indicators, market internals, work best at market lows. Oftentimes, things rotate around, and looking at these particular indicators, they're not quite as reliable at highs or as the market's making highs, as opposed to when the markets are selling off and these indicators get oversold and start turning. So there's an interesting thing to note. It'll be interesting to see how this particular incident plays out. Now, in terms of market sentiment, I had also mentioned that volatility is extremely low, and I just want to go through the VIX chart. So one of the things you can see is intra-week we got a nasty sell-off, and volatility really spiked up quite a bit, and then of course backed off. One of the things I really want to focus on is when we often get a blow-off top where sentiment gets really insane, the volatility will drop beneath the lower Bollinger Band, or at least get close to it. And in this particular case, you can see the VIX, VIX.X, not even close to the lower end of the band. And so you can say that sentiment, as expressed by option volatility and premiums, not excessively low. In fact, they've been lower back in July and even back in early October. So with this move up, regardless of what the press is saying in terms of sentiment being excessively strong, volatility on an empirically measured basis is not showing that. So that is supportive to continued movement in the market. Okay, now let's take a look at a couple of other more interesting indicators. And that is, let's take a look at trends by market cap. And one of the things you can see, of course, here is that the Dow, right, in terms of its strength relative to the S&P, still extremely strong. We actually are in a little bit of a pause mode, but as you can see, the Dow versus the SPY using our triple play indicator shows extreme strength on a relative basis. Not so much on mid cap, and you can see even though we got this huge spike up in IWM and small cap, we've sort of been retreating as the market has moved sideways. So the Dow looks like it's in the strongest overall position to move when you take into consideration, got about 4 or 5 days of what I would call compression, and that could certainly power a stronger move out to the upside. Now, conversely, if we can take out the highs above the 150 level, 150.50 in the IWM, that could propel a pretty strong move and really take out all of this sort of sideways action of recent. Okay, going into the worldview. Now, actually, what I want to do, I want to take a look at gold and oil, but actually mostly oil. So to me, the core and the biggest opportunity here right now, that's still early while this is emerging, is look, you sort of have what I would consider a head and shoulders bottom pattern forming, where we just broke out from really sharply on Friday. And take a look at this. If you look at the USO versus the SPY on our ratio chart here, this is our triple play indicator, is you've got a scenario where you've got a breakout from this big base here. And that could definitely power a move much higher. On our real motion indicators, we also have got a breakout in terms of momentum. It sort of led before you had the breakout here, and that was very helpful to our discretionary trading that we are definitely in this one. And this looks like we're starting to really break out of this base. So out of all the commodities, this oil definitely looks really strong here, and that is something to pay attention to, because it could materialize into something much stronger, especially as the economy stays on the growth track that it currently is. Okay, so taking a look at ags and copper, one thing, we definitely got a pause in copper, and it's sort of in the middle of being stronger on a 6-month basis relative to the S&P. As you can see, our red here, the red is the actual ratio. The moving average here, this blue line here, is the 6-month moving average. So even with this great move in stocks, copper on a longer term basis has still been moving up. And you can see it's holding right now in terms of momentum right around its 50 and 200 day of real motion, coinciding with the 50-day moving average on the price chart. So we're looking for copper to hold in this particular level. What's also starting to look a little bit more interesting is agricultural commodities. You can see it's trying to come out of its base down here relative to the S&P. Hasn't quite broken out yet. I'd like to see a little bit more strength and really a move above the 200-day moving average. But for those who want to try to catch a potential earlier move, you can certainly play it in here with a stop below 1890 or so, which is the 50-day moving average. So commodities overall really looking interesting, led by oil. So again, DBA, soft commodities, includes sugar. This will certainly smooth out the return or your play, as opposed to playing any individual ag-based commodity play. All right, so as you can see, we got some interesting themes happening. Let's take a look at the short-term charts on the S&P, on the Dow, and we'll wrap it up from there. So this is a 5-minute chart of the Dow. We've got floor trader pivots and the 10-day moving average just beneath all this action. So what I happen to like about this particular chart, as opposed to some of the other indices, is that you've got enough compression here that once we break out to the upside, it could power a really strong move. And you also have pretty tight risk controls. So this green here, the first bright green, is R1. An OR breakout above this R1 level that also takes out the recent highs here coincide around 235, or actually just a little bit beneath it, maybe 230, 234, 75 to 80. And again, you can certainly wait for it to clear 235. Now, what I would be doing is placing my stop, and this would definitely give me pause about the overall trend. A OR breakdown or a failure beneath the 232 level on Monday, tomorrow, would definitely cause some trouble in the overall market and put me on pause about the overall rally, and a potential short-term correction could be underway. So you've got about 3 points here of risk. Obviously, you're playing for a lot more to the upside. Now, if you're a shorter-term trader, risking 3 points and then looking for 9, it's looking for another 1,000 points in the Dow. Now, that may seem crazy, but with the market with absolutely no upside resistance here, that is certainly a possibility. However, in terms of risk reward, if we wanted to play this breakout with a tighter stop and take off money a lot more quickly, you can certainly use the low and the OR breakdown beneath the lows of Friday, which come in around 233.35 or so, right around here. So that would reduce your risk by half. You can certainly then look for a profit target around 238 or so, which is about a 300-point move in the Dow. So at least 2 to 3 times your initial risk makes sense, but this is the only real logical stop on a shorter term basis, right? So if we take out these highs in here and we place our stop here, that equates to about $1.50 worth of risk in the DIA or the Dow ETF. So that's the one I'd look for here. That's about the tightest risk reward you're going to get on any of the indices. All right, hope this all helps. Good luck with your trading, and bye for now.